Welcome. This is a live recording of an interview with Gary Kaminsky for the Resilient Advisor Show. If you're watching while we're recording this live and you'd like to ask a question, if you're on LinkedIn, YouTube, Twitter, or Facebook, simply make a comment and it'll be pushed through to the virtual studio and I'll pose it to Gary.
This is the Resilient Advisor Show with Jay Coulter.
Thanks for tuning in to this episode of the Resilient Advisor Show. My guest today is Gary Kaminsky, making his second appearance on the Resilient Advisor. And I have to tell listeners and viewers, his last appearance was our most popular episode by far. Gary, thanks so much for coming back on.
Jay, great to see you. And if you see me looking camera right, it's just to make sure we check the battery on this iPad. As your viewers, we should tell your viewers, it was a last-minute switch from an iMac to an iPad. So hopefully we're good.
It's a lot different from your days at CNBC when you come into Resilient Advisor in a virtual studio for sure.
All good.
All right. So we're here to talk about some of the thought leaders that you had on the Magnifi Media program over the past week. And as always, really big name guests. The biggest name guest is Cathie Wood, who was on recently. What was your take from the Magnifi Media interview with her?
Well, you know, there was so many things, and I think we're going to cover a bunch today. But I've known Cathie, and again, I'm going to put my old PM hat, portfolio manager hat on. What I think was most important was Cathie's explanation and emphasis. If you are an advisor out there and you've decided in the past or in the future to make an allocation to one of the ARC high octane funds, it's your responsibility to recognize what percentage of that is for your client assets. If you're going to make an investment in that, and we can think back, Jay, to the Ken Hebner world of the 1990s or the Garen von Wagner, there are high octane portfolios out there. And I think a lot of people have forgotten that if you're going to put that into a overall asset allocation, you as the advisor should figure out what it's worth. Now, personally, what I thought was great and what is near and dear to me, and let's go back to our history together at Neuberger Berman. When we launched the All Cap Core product, we had a difficult time because the world did not want something that did not fit into a style box. And for those that are out there that don't understand, a style box meaning your large cap growth and your only large cap growth, your mid cap value, only mid cap value. You've heard me say it on the road. You've heard me say it for a long time. To make investments based on that criteria is just plain old stupid. If you're going to put your client's assets in a fund that's just going to closet index that benchmark, just buy the index. Don't buy an active manager. Much like Cathie talked about her active management style, our active management style, that's how you try to add value. And that's the only way you could really add value in a non-closet index, in a non-style box strategy. In fact, let me take this opportunity to give a friend of mine and a friend of yours, George Raffa at Raymond James, who was the first institution that accepted the All Cap Core for not wanting to be in a style box. And between you and our other colleague, Keith Wagner, and George Raffer, and we're all working together now with Capital Wealth, another friend of yours, Kevin Simpson, who's also not in the style box. That's how investment advisors add value. If you want to just closet index, buy the index. And what I took away from Cathie, again, the emphasis that she's going to buy stocks that are not your traditional growth stocks, that are large cap growth stocks. If you want to buy the FANGs, you're not going to go to her. You want to find what she calls innovative companies that might be trading at crazy valuations. That's how you think of the asset allocation.
Yeah. And so, Gary, when I think about how you and I met at Neuberger Berman and we were out pitching the All Cap Core story from Team Kaminsky, what made it stand out were the risk controls that it presented for financial advisors that wanted to show that to a client, was actually out of the norm at the turn of the century. And one of the takeaways I had from the interview with Cathie Wood is her thoughts on risk controls. And I want to play you that clip, but any listeners and viewers, if you want to see the full interview, head over to magnifi.com/media. But here's Cathie on risk controls.
We are focused exclusively on disruptive innovation. And when they say, where is the risk management or the risk control? we have many levers of risk control, including our partners who oversee the risk in their portfolios. And I'm talking our minority partners and our distribution partners. So we are fielding questions and are thinking carefully about the risks we're taking, certainly in the context of the questions we're getting. But it's been built into our scoring system, our top and bottom, top down and bottom up modeling. There are risk assessments each step along the way. I think many people confuse generalist portfolio managers who have to shift between this sector and that sector, or between cash and no cash. We're not doing that.
So what's your take, given your long history with having risk controls inside of a non-style box portfolio?
Again, let me make this emphasis, and this really, really is super important. If you're going to have a high octane portfolio, whether it's high yield bonds, equities, even commodities, it's the responsibility of the advisor to determine the risk management protocols within the overall asset allocation. Now, each individual manager is going to have their own parameters for what risk management could be. I'm sure, Jay, you've had a number of people on the program who say that even if the fundamentals haven't changed, if a stock is down 12%, they've got a stop loss order in or things like that. Everyone has their own style, and I'm not going to sit here and criticize anybody's style. I think in Cathie's, the way Cathie manages money is she believes that you find these innovative companies that are going to be highly disruptive and changing. I'm not going to get into her thoughts about valuation because I really can't. But I think that the point is that something leaves the portfolio from a risk management perspective when something changes at the company, not just because the macro environment has had the stock go down a certain percentage. Again, one can argue with that. One can say that that's not the way they want to risk manage. But her performance over the last decade, speaks to the long-term value creation if this is going to be within the asset allocation. You said, we're going to talk about commodities later. Great interview we had with Mark Fisher. Again, that's a subset within an asset allocation, and commodities are almost as volatile from time to time as high growth, octane, no earning stocks. And you've got to use the same kind of thinking from the top down. So it's important to remember, if you're going to make this asset allocation, recognize you're investing in a manager, be it Cathie Woods or somebody like that, who's not going to change their discipline just because of the macro environment.
Yeah, so Melissa Francis did a great job with that interview. I'm going to play a few more clips, but the one that I've been teasing all day to my audience is her thoughts on Elon Musk and Twitter, because everybody wants to know what some of the more pro-risk managers are thinking about how this could play out. I'm going to play the clip, and then, Gary, I'd love to get your take.
Yep. So if Elon Musk does get control of the company, would you adjust that upward? Do you think it has more potential with him in charge, or would it be more of a wait and see? How would you feel?
We probably would have more confidence in the platform, would want to hear what Elon has in mind in terms of perpetuating the platform. I'm sure he does not want to run it as a charitable organization or a nonprofit. So we'd like to see how he thinks it could become a very transparent, but also self-sustaining model. And, he's very creative. And I think that it is our global town square, and that a lot of people would miss it. So I think there will be a lot of people very supportive and very open to his ideas.
Gary, a lot to unpack there. Not just your thoughts on her comments. Also, what are your thoughts about this potential acquisition?
Well, Jay, you and I have had some off-camera conversations about Twitter. I know it's an important mechanism for information distribution. I happen to be one of those people that I had a Twitter account that was set up years ago by CNBC. And honestly, I had a hard time, and that's because I'm not a technology guy, figuring out how to find the important information nuggets without all the junk that was, constantly clogging up my, I guess it's called your feed. So I think if Musk could come in there and find a way to make Twitter a valuable I guess the word they've been talking about all week is, global town hall where information can free flow. And yes, there will be criticisms. There'll be some negative feedback. That's part of free speech. But the amount of junk that's just complete junk, as a user, I found it just a complete waste of my time. So I'll leave it at that. As far as Cathie and Musk, let's remember, for the viewers that don't know, Cathie was one of the earliest investors in Tesla, and as a result of that, has a very close relationship with Musk. And I don't know how frequently they talk. I know they have direct communication. I think what was interesting, listening to the interview yesterday live, was, and this was around 3 o'clock or so when Cathie said, 3 o'clock Eastern, when Cathie said, I think, from what I believe, there's going to be some other entrants who are going to come in to take a look at the company and possibly make a bid. And I don't know if she's got any specific information related to that, or just along the simple fact that now that this company is in play because of Musk, it's hard to imagine it remains a standalone entity, because either he keeps this large percentage, as he's tweeted out and as he's mentioned, the board basically owns no stock, which I think, going back to my own investment criteria, we would never own a stock like that with such little representation of shareholder equity at the board level. I mean, disgusting, actually. And so with him there, there'll be some change. He'll agitate for change, whether it's through an acquisition, through an ultimate tender, or force something else into some other hand, or maybe he just decides that he's got the attractive financing to take this thing private. But it's hard to imagine this is a standalone entity.
Yeah. Yep. All right. So I want to play one more clip from Cathie Wood. And here's why this one stood out to me, because I knew I would be interviewing you. And as my audience knows, as a marketer, I believe it's important to give as much information away as you can. Keeping information yourself does not help you build your brand or serve people. And when Team Kaminsky was rolling out their products at Neuberger Berman, one of the things that made you stand out in the marketplace is you gave your research away. You shared what you were doing. You educated advisors. What Magnifi Media is doing today by bringing on these great thought leaders to come on and share their thoughts on the marketplace and portfolio positioning is serving folks. And listen to Cathie talk about how and why, most importantly, they give all their research away.
We give our research away, not because we are altruistic, although we do want to educate not just investors, but parents and grandparents about how the world is changing and how rapidly it's changing, and how to keep their children and grandchildren on the right side of change. And even for adults, how to retrain. So much is going to change because of the 5 innovation platforms: genomic sequencing, adaptive robotics, energy storage, artificial intelligence, and blockchain technology. So much is changing. And those platforms themselves, they're all growing at exponential rates, and they are converging. So it's one S curve feeding another S curve. And we want people to understand that. We want not just investors and registered investment advisors, but also, as I mentioned, the sell side and the buy side. They're used to very short-term time horizons, and they haven't until recently been as focused on these new technologies. They've been much more focused on benchmarks and how to beat benchmarks. They haven't been thinking as much about the future and the technologies that are going to transform the future.
That sounds just like you in 2002, Gary.
Well, even more so, because I am a little familiar with the practice here. Jay, we had a belief, if you recall, and again, I go back to Ray James. This all originated when I was with Wagner at a Ray James conference down in New Orleans, if you remember that, and listening to some of the other managers who were in the managed account program. And we've told this story, I think, before, about one of them who said, NASDAQ was down 27%, I think, year to date at that point. And this was, mid 2000, and said that, our portfolio was down 18%. We had a tremendous value, and I got to run. I got a private plane waiting for me, take me back to Nashville. So, it was things like that made me realize if we just shared our research ideas, why something was going in the portfolio, why something was coming out of the portfolio, with advisors that there was no secrets. It was, again, in baseball, if you hit 400, you're in the Hall of Fame. In investing, if you hit 700, you're in the Investment Hall of Fame, which means that, 30% of the time you're going to be wrong. You're going to make mistakes. Things are going to change. A company says that they're going to grow the dividend. They decide that they're changing their capital allocation. You decide to sell the stock is down. It's important to communicate that. What makes the ARC plan even somewhat different, and even more so than pretty much, I think, any institution out there that I know, they want to share the financial models. So they don't want to just share the research ideas, because Cathie is a punching bag in the media for making some outrageous price targets. Again, I'm not going to make a judgment call on that, but when they make the judgment call on the price targets, they back it up with their own financial modeling, which is saying, okay, if you think we're crazy and you think we're wrong, here's how we're modeling out the company in 5 years in terms of subscriber growth or revenue growth, EBITDA operating margins. So instead of just saying these are ridiculous headline grabbing price targets or price or models to derive price targets, here's how we get there. Here's what the financial modeling is, to give everybody that open architecture opportunity to not just criticize, but to actually criticize specifically if they think the assumptions are wrong. And I do applaud that when I put my PM hat on for certain.
Yeah. Yep. All right, Gary, let's pivot to commodities. And we're going to play some clips from Mark Fisher. For those in the audience who are not familiar with Mark Fisher, admittedly, I was just introduced to him about a year ago when he was on Covered Calls with Kevin Simpson that we helped them produce. Not only is he one of the smartest guys I've ever seen interviewed, he's also one of the most generous people with the money he's made in this world. And just such a great, great story. The first clip I'm going to play is about his thoughts on commodity dips today.
Now I think what has to happen is you have to root for a dip in commodity prices so that you can buy that dip. I think that there'll be a couple of scary days when, hopefully when Russia, Ukraine reaches some kind of settlement, hopefully sooner rather than later. I think that the knee-jerk reaction would be obviously to sell all commodities and the world's going to get back to normal. I don't really think that's the case because of the sanctions. But again, I think the mentality has changed from buying the dip in securities. It's now buy the dip in commodities.
Buying the dip in commodities. So, Gary, I'd love your thoughts on his philosophy there. But more importantly, how can investors and financial advisors best allocate to commodities in a portfolio?
Okay, well, for those that don't know Mark Fisher, longtime, lifelong friend of mine, so I just call him Fish. The thing with Fish is that if you want to trade against Fish, what's a good cliche there? Do so at your own peril, because this is the greatest mind that I know in terms of trading the markets, which, remember, is very different than investing in the markets. Fish has got this incredible capability to be in the oil pits, decipher what's happening. I did ask him in that show, if you watch the whole show, I did ask him a little bit about the origins of how he got into trading, because I think it's also pretty interesting in terms of the skill set that he thinks makes for good traders. That's a bit of a tease, but I think it's important if you want to watch the whole episode, what he thinks are important characteristics. I kind of thought it was intriguing. For the last 30 years, since really the 87 crash, so you go back to the 87 stock market crash, the philosophy of buying the dips when bond prices rose and bond yields spiked and prices went down, and you bought bonds, you made money. And same with the stock market. Even the internet bubble, if you stayed true to a long-term investing, the financial crisis, you always had higher highs coming out of these various different cycles. And I thought it was very interesting when Fish said, look, the buying the dip mentality worked for 30-something years in stocks and bonds. Didn't necessarily work for commodities, but we're in a very different world now. And maybe what's happening in Ukraine and what's happening in terms of the interest rate cycle and what's happening in terms of just global supply demand, you've got a scarce, commodities are scarce resources. Yeah, you can, try to produce more oil. You can try to grow more corn. You can grow more soybeans. And there are cycles commodities were always treated as an asset allocation in terms of a highly cyclical area of asset allocation. I found it intriguing, and if one does want to take a, Jay, you're sort of setting me up here for the beauty of Magnifi. If one wants to look for how do I invest in commodities through a commodity ETF or commodity managed account product, you don't necessarily have to be an expert. You can go to Magnifi into the search bar and say, I want to invest in a commodity ETF. And you'll have a selection of, based on relevance, performance, fees, to determine what's a way to do it. If you don't want to make investments in futures in the actual raw commodities, which doesn't provide the same instantaneous liquidity and also is subject to, I think, more day-to-day volatility than a diversified ETF that's exposed to the commodity cycle. And that, by the way, was the first time I heard Fish, talk about commodities in that sense. In terms of buying the dips for the next several years as an investment, as opposed to just trying to trade the cycle.
Yeah, and I suggest watching the whole interview with Mark Fisher. Like I said, he's one of the smartest people you'll ever see interviewed. Go to magnifi.com/media and catch the whole interview. I do want to play one more clip from him because, as who I believe is one of the preeminent thought leaders on the energy markets, his thoughts on crude I thought were quite telling.
So I think if I was an investor today, I'd want to invest more in the refined products than actual crude oil. Can crude oil go down $10? Yes. Can go up $20? Yes. But the risk reward isn't there anymore in crude oil for me. The risk reward is more in believe it or not, in crack spreads, which is the relationship between heating oil and gasoline and crude oil. The back of the board of crude oil, because obviously the market's in backwardation, which means that the front of the board is trading at a significant premium to the back of the board. And I don't think we're going down anymore for various reasons, including the fact that the government has to buy back this SPR reserve in 18 months to 24 months.
In the last couple of interviews, you had Kyle Bass on, and he's predicting $200 oil. You had Gunlock on. He was talking about, I believe it was $150 oil. And here you have energy trading legend Mark Fisher not allocating to crude now. Isn't that amazing?
Well, remember, because again, if you watch the full interview, and for those that will watch the full interview, apologies that I had to host that show. Melissa was traveling. I tried to do the best I could. But please don't, listen to the information is very relevant, although the host might not be that good. I sort of forgot how to do it, Jay. Anyhow, Fish's point was the risk reward in natural gas is just that much greater. And so when you're a trader and you're thinking about the parameters, it's not that he's going to disagree about the crude oil move, but he thinks a natural gas long investment position is so much more compelling today. And we taped that show early Thursday last week, Friday being a market holiday. And if you're watching us live now, the stock market was up sharply today, primarily because there was some profit taking in the energy space. He had just the timely call that he had midday Thursday in terms of the move up here in natural gas on a technical basis. Big day yesterday, little profit taking today. And again, Fish says you use a day like today as where the profit taking to establish a position, an asset allocation, a position into something like natural gas, not the days when it's up, the days when it's down.
Yep. Yeah, it was a great interview. Again, magnifi.com/media to get the full interview. Gary, let's wrap up and talk a little bit about private equity, something I know that you're very well versed in nowadays. You guys had Marty Nesbit of the Vistria Group on, and I want to play a clip on his thoughts on the importance of private equity.
One of the beautiful things about building a private equity platform is the opportunity to be really focused in an industry or a subsector of an industry where you can develop real expertise. And so we spend a lot of time developing themes that we want to invest behind and then going very, very deep so that we know the levers to create value, what the long-term proposition is.
So Gary, as an experienced private equity investor yourself, when you hear him talking about the importance of going deep in these projects, how do financial advisors take that type of resource and get it into a portfolio?
Well, again, Magnifi's got the ability, as we describe in the show, to identify managed accounts or ETFs that focus on the publicly traded private equity space. A lot of the private equity investments, direct investments, have high minimums, and so you can't directly invest in the deals, but you can invest in the parent companies that benefit, obviously, from the growth in PE. And I think, Jay, as I'm sitting here thinking, if I had to sum up, we did the 6 shows, and if I had to sum up maybe like an overall macro theme here, whether it's fish with commodities, whether it's Cathie with a high octane portfolio, Gunlock in terms of the bond space, and obviously Marty on private equity. And you just think about what worked for the last decade. If you were an advisor, and you followed the 60-40 rule and you put a bunch of money on the equity side into index or closet index funds, your clients were pretty happy. Obviously, this has been a very difficult first 4 months of the year. You look at bond prices. While professional investors like you and I knew exactly what would happen in terms of the bond market here with rates going up, clients got their statements for the first quarter. They looked at the bond asset allocation. They said, really, does this 60-40 work anymore? And I think for the next decade, for the next 8 years, let's call it, for the rest of this decade, just putting money into spiders or just putting money into index funds is going to significantly underperform a fully managed portfolio that's going to have some private equity. It's going to take advantage of some of the companies that are in the private market that are able to shield themselves from the public scrutiny from quarter to quarter. You're going to have an asset allocation to commodities, whereas you might not have had a direct asset allocation there. And if you're going to look to try to time something like a high octane portfolio, be it again in the credit markets in high yield or equity markets like in ARK Innovation, it's a percentage. It's kind of, if you remember when we had Mooch on, Scaramucci, on the crypto show. And it's funny, I think that was about 2 months ago, Jay. I'm like many out there. I'm still trying to figure out. I don't own any crypto, never have, never invested. I listen to both sides of the story, and I wonder, in this rising interest rate environment, in this world where people are kind of fed up with the central banks for how they've handled things, I do wonder to myself, is it necessary to have a crypto allocation? So you think of all these things, and is that the new 60-40? Is the new 60-40 model portfolio going to be various different subsets of these different disciplines? And I think we can say, we have other people listening, but let's just imagine it was the two of us on this conversation. I think we could say that the big wirehouses are not going to, again, it's style box. It's like Rafa thinking outside of the box. The big firms are not going to put the 60-40 model and blow it up now. They'll blow it up 2 years from now after it's significantly underperformed. So you want to think ahead of it. You want to think about different strategies. You mentioned Kevin Simpson. He's got a great covered call strategy, which is not correlated to the S&P, adds incremental value. There's tons of managers out there that are going to think outside of the style box. We try to do that with Magnifi Media to let advisors recognize what the new model is going to look like.
Yeah. So, Gary, we have a comment from a live viewer on YouTube. They say, I thought investing in private equity was only for accredited investors and high net worth people until Gary explained private equity ETFs, opening another door to diversification and wealth. Gary, that's along the lines of what you were just talking about, and nicely tees up the last clip that I would like to play for everybody. It's actually a clip of you, Gary.
Let's put it to the Magnifi search bar. How do I invest in natural gas? And we'll do the search on the best returns. And this is what comes up. We've got the United States 12-month natural gas fund LP. We've got the commodity index tracking fund and the commodity strategy one class, I class, and VIX midterm futures. So again, using Magnifi for an individual investor, an investment advisor, to try to figure out ways to get long natural gas and stay long natural gas in your portfolio. These are great examples of things that are completely objective searches based on, again, long-term best performance.
As somebody who has managed billions of dollars, that example there shows you how you could search for commodities, natural gas in particular. You could do it with private equity like we just discussed, or innovative technologies like Cathie Wood is going after. How could a financial advisor today leverage the Magnifi platform to help their business?
Yeah, it's real simple. You go to Magnifi, you check it out. You can register. Doesn't cost any money to check it out and see if it's adding value in terms of your asset allocation selection, your stock selection. You have clients, for example, that might have a very large position in one security. We like to use the example, somebody who might have bought Amazon at the IPO and kept it, for 20 years. They've got an overweight in a taxable account. They've got a huge position in Amazon relative to other things. They may have decided not to invest in technology as a result of that. Well, the beauty of Magnifi is you can find various different products that are invested in technology that don't include Amazon. And I just use that as one example. So you can go into the search bar, and this is what really got me excited, thinking about, okay, a client walks into us, Jay. We meet with that client. The client's got a legacy position. We're trying to figure out, well, we don't necessarily run an ETF strategy. There might be something out there where the client can make their own personal asset allocation into a security that will omit or not include something that they've got a big position in. And it works both ways. There are clients that want to avoid certain subsets, alcohol, tobacco, even today with the publicly traded marijuana. There's clients that want to specialize things, but they want to basically participate. That's the beauty of what this search mechanism could do.
Yeah, so my audience knows that I tend to get married to certain technologies when I find they add value to an advisor's business, whether it's WealthBox on the CRM side, Asset Map on looking at a family's household finances in a simplistic view, Right Capital, even Y charts. The Magnifi search bar is unique, and it can really help you flesh out new investment ideas and have different conversations with your clients. Gary, I appreciate you coming on. Advisors, check out Magnifi by going to magnifi.com. And to watch the full interviews with all these thought leaders, head over to magnifi.com/media. Thanks, Gary.
Thanks, Jay.